Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the International Accounting Standards IAS 1 2 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. One of the main aim of IAS 1 is to ensure that the accounting records are a fair presentation of the business concern and is in full compliance with IFRS. Fair presentation requires the faithful representation of the effects of transactions, other events, and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income, and expenses set out in the framework. Statement of financial position. Let's understand the statement of financial position fair presentation to ensure compatibility. Current and non-current classification. This is the main classification of the statement of financial position fair presentation. Assets and liabilities are classified as current if the assets, for example, is expected to be realized or sold or consumed, and liabilities are expected to be paid without any hindrance within the normal operating cycle, that's no later than 12 months after the end of the reporting period. Another of the classification is that the asset or liability is held primarily for trading purposes. An asset is cash or cash equivalents on which there are no restrictions to sale within 12 months after the end of the reporting period, and a liability where an entity shall not have an unconditional right to defer settlement for at least 12 months after the end of the reporting period. Non-current asset or non-current liabilities. All others expected as indicated above are non-current assets or non-current liabilities in that case. To understand better regarding the classification of current and non-current liabilities, let's take the example as follows. The company has three loans: $100,000, $200,000, and $400,000. And the due date of the third loan is 2 years, and first and second loans are due, but the company has signed the grace period agreement of 2 years after the date of the financial statement. In this case, $300,000 will be shown in current liabilities even though the grace period was signed for 2 years, and the third loan of $400,000 will be shown in non-current liabilities on the basis of the original agreement, even though the grace period has been signed after the end date of the financial statement. Statement of profit and loss or other comprehensive income. Now let's understand the statement of profit or loss or profit and loss or other comprehensive income fair presentation. Changes in the revaluation respectively in the revaluation reserve of fixed assets must be under IAS 16, that's property, plant and equipment, and IAS 38, that's intangible assets. whereas actuarial gains and losses under IAS 19 employ benefits and exchange differences from restatements of financial position statements of foreign operations in foreign currency in accordance with the IAS 21 effects of changes in exchange rates. This item applies only to consolidated financial statements. For example, changes in revaluation reserves and actuarial gains and losses should not be classified to profit or loss on disposal because they do not reflect actual transactions. However, exchange differences on the translation of foreign currency financial statements should be reclassified after disposal as they would result from transactions. In such cases, it is necessary to additionally present corrections from the performed reclassifications. The items of other comprehensive income can be represented in one of two ways in terms of the tax effect they would generate. First, net of tax expense, and second, before the tax effect and with a separate article about it, gross presentation. According to the grouping of operating costs, there are two possible options for preparing the income statement. Number one, if the entity chooses to present them on a gross basis, that is, in a sense of cost, then the appropriate classification of cost is by economic elements. In this case, the operating costs include the cost of economic elements. Depreciation, purchase of material, transport costs, employee benefits, and advertising costs. In terms of turnover and for purpose of presentation, they are usually grouped in some items, regardless of which account was initially reported. In this model, the items of a corrective nature should be presented separately. Increases and/or decreases in work in progress and/or finished goods, as well as the value of the assets actually created in the balance sheet. Increases in work in progress and/or finished goods should be presented with a plus sign, while reductions should be presented with a minus sign, and this should be compensated. If the entity is productive and chooses to present operating cost on a net basis, then the appropriate classification is by cost function. In this classification, the initial economic content of cost is not taken into account, and in the income statement, they are grouped according to their purpose in the entity. There can be no adjustment items in the classification of expenses by functional attribute, as all expenses are recalculated and comparable to the reported sales revenues. So this is very important here, that all expenses are recalculated and comparable to the reported sales revenues, which that's income. IFRS does not give preference to one or the other approach to presenting costs. Each of them has advantages and disadvantages, of course, which makes them selectable under different production conditions. The presentation of cost on a functional basis is understandable to consumers, but is more complex and subjective as it requires additional redistribution. When adopting this approach, it is required in the explanatory notes to the financial statements to present the cost of the main elements. The explanatory notes are very important in this case. The main elements such as material, labor, depreciation, and others. The functional presentation method is appropriate and is usually applied to larger manufacturing entities with significant residues of finished products or goods and work in progress, as well as with various clearly defined production, commercial, and administrative departments. The presentation of cost by economic elements is easier and implement and more objective as no additional estimates are required to redistribute the cost already reported. It's usually applied by smaller manufacturing companies as well as by trade and service companies. N- Note: the taxable temporary difference will arise, which is the deferred tax liability amount can arise in this situation. Statement of changes in equity. Statement of changes in equity fair presentation. From the statement of comprehensive income, the current financial result, that's profit or loss, and the other comprehensive income for the reporting period. They are presented in one line by their individual elements as the details are already presented in the statement of comprehensive income. For internal transfers from one item to another, example, setting aside reserves from profit covering losses, realized revaluation reserves, etc. For capital transactions with the owners of the entity, increase or decrease of equity, distribution of dividends and royalties, etc. The opening and closing statements of financial position must be reconciled in order to see the continuity and correlation with the values in the statement of financial position and statement of comprehensive income. Last, notes to the financial statements. Notes to the financial statements. They aim to provide systematic textual information on the main corporate issues of the registration, activity, structure, and management of the entity, the adopted accounting base for the preparation of financial statements, and the statement of the management for compliance with IT, the defined accounting policy that's applied to significant transactions and events through its clear description. B. Provide additional numerical and textual information that is considered necessary and appropriate so that users can properly understand the individual items in the elements of the financial statements. Note: a financial statement cannot be properly understood without reading the notes to it. The explanatory notes justify the amounts set out in the four front pages of the financial statements. The way in which the explanatory appendices are prepared is a combination of the following possibilities. A. individual comments and explanations should be presented systematically with a combination of text and numerical disclosures. Here, both are important, text as well as numerical disclosures. Each significant item of the statement of financial position and the statement of comprehensive income should be referred to in separate notes and explanations. Wherever possible, any numerical information should not simply be described but logically arranged in a tabular form. For example, the debt to the EIB on the investment loan, which is the classification of the financial liabilities, as it's a loan, be presented in the statement of financial position of entity X as current or non-current liabilities should be made on the basis of compliance with the terms of contract at the reporting date. As the investment loan has become due because of non-compliance with the financial conditions of the creditor bank as of 31/12/2022, the loan becomes due on demand and is therefore classified as current liabilities. This classification, however, does not change even though the bank has agreed not to require early repayment of the loan within a year. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARSK. Thank you. Have a great day.